Hello everyone, welcome back. In the previous class, you have studied two basic accounting principles. They are cost principle and dual aspect principle. Now let's move to the next basic principle, that is matching principle. According to matching principle, the revenue earned during a specific period should match with the expenses incurred during the same period, and finally the net profit or loss will be calculated by matching the revenue and expenses incurred a during the same period. Okay, whether the revenue is earned or not, or in other words, the revenue is recognized or the revenue is generated but not yet received. Okay, so we have to consider the receivable revenues also. Okay, whether revenue is earned or not, or the expenses incurred or not, we have to consider these events. Okay, for example, uh, matching the cost of goods sold with the sale of goods. Okay, and matching of wages paid to laborers or workers during the financial year with the revenue of that financial period. Okay, so in simple terms, matching principle, according to matching principle, the revenue earned during the year should be matched with the expenses incurred during the same period. Okay, next one is revenue principle or realization principle. According to this principle, revenue should be measured and recorded in the period in which it is earned or realized or recognized. Further, revenues are recognized only when they are earned. So here, revenue principle means nothing but revenue should be measured. This principle says that revenue should be measured and recorded in the period in which it is earned, realized, or recognized. Okay, the revenue is realized only when the title of the goods or the ownership of the goods is transferred from seller to buyer. Okay, whether the cash received or not, okay, it will be treated as revenue for the business. So here the criteria for recognizing the revenue is transfer of ownership of the goods. When ownership transferred to the third party or to the buyer, the revenue will be recognized. Okay, next one, objectivity principle. According to this principle, all transactions of a business should be supported by proper documentary evidences such as bills, receipts, invoices, etc., and no transaction should be recorded in the books of accounts without such documentary evidences. Objective principle says that every business transaction should have supportive documentary evidences to avoid subjectivity or to give unbiased data. Okay, according to objectivity principle, the accounting user can obtain reliable data because each and every events or each and every transactions uh, are supported by documentary evidences like bills, receipts, vouchers, then invoices. Okay, so in simple terms, objectivity principle uh, uh, says that every transaction should have or should be supported by proper documentary evidences. Okay, then fifth one is full disclosure principle. So while preparing and presenting accounting information, the accountant should disclose complete and adequate information honestly, so that the person who relies on them can use it to take sound economic decisions. So, as the name indicates, full disclosure principle means the accountant should disclose each and every transactions which are related to business through financial statements. So it is the duty of accountant to disclose each and every information honestly through financial statements, so that the persons or the users who are relies on them or who are depends on them can use it to take sound economic decisions. Okay, to satisfy the external users like shareholders. So suppose in case of shareholders, their decisions regarding investment will be dependent upon uh, the accounting data given by the accountant, right? Whether to invest or not. So to take effective decision, the complete information about business is necessary. So full disclosure of accounting information will help shareholders to take effective decisions and to facilitate better managerial decision taken by managers and directors as well, and to make organization transparent and to meet legal requirement. So according to Companies Act, each and every business organization should disclose the accounting transactions through financial statements. Okay, and this principle also suffers from a few limitations. There, it makes the financial statements bulky, containing all material and immaterial information. So here, full disclosure principle says that you should disclose each and every transaction of the business through financial statements, right? But it makes the financial statements bulky or lengthy, which contains all material and immaterial information. So here, whether the information is important or not, but it is the duty of the accountant to disclose each and every information. So it makes the financial statements bulky and difficulty in disclosing non-measurable events in the books of accounts. So according to full disclosure principle, we have to disclose each and every events of the organization, but it is not possible to disclose non-measurable events like efficiency of a person or a labor or a manager. So these kind of transactions cannot be measured in terms of money or entry of a new competitor. So of course these all are important for business, right? But it is not possible to express these kind of transactions in terms of money. Okay, these all are about basic accounting principles. Thank you.